There is a question in personal finance that sounds simple, but has a genuinely surprising answer. If you had invested $10,000 in a portfolio of carefully researched individual stocks 15 years ago, quality companies, names everyone has heard of, bought with real conviction, versus $10,000 in a single S&P 500 index fund, which one would have built more wealth by today? Most people get this wrong. And the reason they get it wrong is that the question feels like it should favor the person doing the research. Research is work. Work produces better outcomes than doing nothing. That logic is intuitive, widely believed, and supported by essentially every financial media ecosystem that exists. Stock picking channels, earnings analysis videos, position updates, sector rotations, all of it is built on the premise that the effort of selection produces superior returns. The data disagrees. And the data does not disagree by a small margin or a debatable amount. It disagrees with a clarity that has been reproduced across dozens of countries, multiple market cycles, and more than 20 years of rigorous academic and institutional measurement. This is one of the most settled empirical questions in all of finance. The financial media just does not have a business model that benefits from saying so. Today, we are going to go through the actual evidence, not a simplified version. The real data, what it shows, why it shows it, the legitimate cases where individual stocks genuinely make sense, and the specific math of what choosing the wrong approach costs over a 25-year investing life. Let's start with the most important dataset most retail investors have never seen. Let's start with the professional baseline. Every year, S&P Dow Jones Indices publishes what is called the SPIVA scorecard, the S&P Indices versus Active report. It measures one specific question: how many actively managed funds beat their benchmark index over various time periods? These are professional investors, full-time analysts, research teams, Bloomberg terminals, the best resources the investment management industry can provide. The 2025 SPIVA report found that 79% of all actively managed large-cap U.S. equity funds underperformed the S&P 500 for the year. That is not a rounding error. That is nearly 4 out of every 5 professional stock pickers, with all available resources, failing to beat a fund that does no research and charges 3 basis points in fees, and the numbers deteriorate as the time horizon extends. Over 3 years, 67% of active large-cap managers underperformed the S&P 500. Over 5 years, 89% underperformed. Over 20 years, 93% underperformed. This is SPIVA's most durable finding across its 25-year history. Underperformance rates rise as time horizons lengthen. The pattern is not noise, it is structural. This is the professional baseline. Now consider what it means for retail investors operating with less information, less technology, less time, and no dedicated research staff. If 93% of the people whose full-time job is stock selection fail to beat the index over 20 years, the probability that an individual investor researching companies on weekends will succeed is not higher than 7%. It is lower. Materially lower. The professional has every advantage the retail picker does not. But here is the second data set, and this one addresses the specific question of why the gap exists. Not just that it exists. Hendrik Bessembinder, a professor of finance at Arizona State University, published a landmark study examining every common stock that traded on U.S. exchanges From 1926 through recent history, approximately 28,000 companies in total. His question was simple. What share of individual stocks actually created value above Treasury bills over their lifetimes? The answer was not what most investors would predict. The majority of individual stocks, over 57%, underperformed short-term Treasury bills over their entire lifetimes. And when Bessembinder calculated which companies actually drove all of the wealth created by U.S. equities over that period, he found that the top-performing 4% of companies accounted for the entire net wealth gain above Treasury bills. The remaining 96% collectively matched Treasury bills over time. Let that number land. 4% of publicly traded companies created all of the wealth. The other 96%, on aggregate, were no better than the safest investment available. And this pattern is not unique to the United States. Besembinder's follow-up research found the same structure in 55 of 57 international equity markets. The implication for stock pickers is direct. The entire positive expected return of equity investing is concentrated in a tiny fraction of companies. Own a diversified portfolio through an index fund, and you automatically own all of them, including the 4%, before anyone knows which companies those will be. Pick a concentrated portfolio of 12 to 15 stocks, and you are attempting to identify and hold that 4% in advance, in real time, in competition with professional investors who are attempting the same thing and failing to do so 93% of the time over 20 years. When people compare individual stocks to index funds, they almost always compare the gross returns, the headline numbers. Nvidia up 400%. Index fund up 80%. That comparison is real, but incomplete. 3 specific costs transform that comparison, and each of them runs silently in the background of every active portfolio, without appearing prominently on any statement. Cost 1 tax drag in a standard taxable brokerage account. Every time you sell a stock that has appreciated, taking profits, rotating into a new position, rebalancing you, trigger a taxable event. Short-term gains taxed as ordinary income. Long-term gains taxed at the capital gains rate. And the average active retail portfolio turns over somewhere between 15 and 30% per year, according to behavioral finance research, across large populations of retail investors. Each of those turnover transactions generates a tax bill. An S&P 500 index ETF like VU turns over approximately 2 to 4% per year. Most of that turnover is handled through the ETF creation and redemption mechanism in a way that avoids triggering taxable distributions to shareholders. The index investor in a taxable account is paying capital gains taxes primarily at the point of final sale, not annually throughout the holding period. The compounding difference is significant. Every dollar that goes to taxes during the accumulation phase is a dollar that stops compounding. A stock picker, paying, for example, $2,000 per year in capital gains taxes on active trading, is not just losing $2,000. They are losing the 20-year compounding of that $2,000. Which at 10% annual return is over $13,000 per annual $2,000 payment over a 25-year period. Tax drag from active trading in a taxable account can consume a significant portion of the advantage the individual stock selection would need to generate just to break even with the index. Cost 2 behavioral drag. The second cost is documented by Dalber and Morningstar and confirmed across decades of behavioral finance research. People who hold individual stocks behave differently than people who hold index funds. They feel differently when stocks move, and that feeling drives decisions that have a measurable cost. Individual stockholders sell winners too early, locking in gains that would have continued to compound. They hold losers too long, averaging down into declining positions, or refusing to take a loss, because selling makes the decline feel real and final. They concentrate in names they follow closely and feel comfortable with, which is often an investment in the company's story rather than its valuation. And during market downturns, they are more likely to sell individual positions than to maintain them, partly because the individual company's bad news feels more specific and more actionable than the abstract market decline that hits an index fund. Morningstar's Mind the Gap study found that investors in actively managed funds earn, on average, 1-2 percentage points less per year than the funds themselves return entirely from behavioral timing of entries and exits. Research on retail stock pickers specifically suggests the behavioral drag is larger than for fund investors, because the emotional relationship with individual company ownership is more intense than with a fund. 1.2 percentage points per year sounds small. Compounded over 25 years on a $100,000 starting investment, it represents approximately $85,000 in foregone wealth from behavioral drag alone. Cost 3. The research time problem. The third cost is the one that almost never appears in any financial calculation, because it is not a financial number. It is time. A retail investor who takes individual stock selection seriously, who reads earnings reports, follows sector news, tracks competitive dynamics, evaluates management teams, and maintains conviction in 12 to 15 positions, is spending real hours per week on research. 4 hours. 5 hours. More during earnings seasons or major market moves. Over 25 years, that is a significant investment of the most finite resource anyone has. The index fund investor spends approximately 0 hours on portfolio research after the initial setup. Their 25 years of research time goes somewhere else, into their work, their relationships, their health, their skills, their actual life. The question is not whether stock research is intellectually interesting. For many people, it genuinely is. The question is whether the 25-year research investment produces a return above the index that justifies the cost. For 93% of professionals, it does not. For retail investors operating with less information and less time, the probability of a different outcome is not encouraging. Let me run a specific scenario, not the best case for either side, and not the worst case. A reasonable, realistic comparison. 2 investors, both 32 years old. Both put $800 per month into a standard taxable brokerage account. Both earn the same income, pay the same taxes, and invest consistently for 25 years to retirement at 57. The only difference is what they buy. Investor A, the index investor, buys VU every month. The S&P 500 ETF. No research. Expense ratio, 0.03%. Turnover, approximately 3% per year. Taxable events during accumulation, minimal. Behavioral decisions made, essentially none. The contributions land. The fund grows. The investor checks it quarterly. Investor B, the stock picker, holds a concentrated portfolio of approximately 15 individual stocks. She is a reasonably good stock picker. Not exceptional, she is not finding the next Amazon before it becomes Amazon. but she is selecting established quality companies with genuine research behind them. Her gross return before all costs is assumed to be 1 percentage point below the index, annually consistent with the documented performance distribution of retail active investors, and far better than the median active manager result. 1 percentage point. That is the starting assumption, and it is already generous. The documented median underperformance is larger, but 1 percentage point below the index return gives the most favorable, reasonable starting point for what active selection can produce. Now apply the 3 costs. Year 10, the index investor's account, approximately $154,000. The stock picker's account at 2.5 percentage points below the index annual return, approximately $133,000. A $21,000 gap. Year 15. Index, $263,000. Stock picker, $215,000. Gap, $48,000. Year 20. Index, $428,000. Stock picker, $330,000. Gap, $98,000. Year 25. Index, $680,000. Stock picker, $489,000. Gap, $191,000. $191,000 from a starting point that assumed the stock picker was performing 1 percentage point above median, better than most of her peers, while applying costs that are conservative relative to the documented data. Under median assumptions, the gap is larger. Under worst-case assumptions, it is significantly larger. If I stopped here, I would be doing the same thing I criticized the stock-picking media for doing, telling only the side of the story that supports the conclusion I arrived at before running the analysis. Individual stocks are not wrong in every context. There are 3 specific situations where the case for individual stock selection is genuine, and I want to be precise about what they are. The first is inside a tax-advantaged account. Every cost argument made in the previous section depended on a taxable brokerage account. Inside a Roth IRA or a 401k, realized gains are either tax-deferred or completely tax-free. The tax drag of active trading disappears. The compounding penalty of annual tax bills vanishes. If you are going to pick individual stocks, doing so inside tax-advantaged account space is the correct approach, not because the selection probability improves, but because the most concrete and calculable cost of the strategy is eliminated. If you have available Roth IRA contribution room and want to try individual stock selection, use it there, not in your taxable brokerage account. The second is genuine domain expertise. The SPIVA data measures the performance of professional generalist analysts and managers attempting to evaluate companies across sectors they understand broadly. The data looks different for investors with specific, deep, operational expertise in a narrow domain. A semiconductor engineer who reads chip design papers for intellectual enjoyment has an analytical edge on semiconductor stocks that no generalist fund manager can replicate. A physician who understands the mechanism of a specific drug class in clinical development has real informational advantage over analysts without medical training. These edges are real. Warren Buffett calls it a circle of competence, the specific area where your knowledge is genuinely superior to the market's collective judgment. Most retail investors have general financial awareness. That is not the same as domain expertise. The circle has to be real, not aspirational. The third is a long, genuinely committed holding period on a small number of positions. The tax drag of active trading disappears if you never trade. The behavioral drag of rotating in and out of positions disappears if you hold through every cycle without selling. The research cost becomes fixed rather than ongoing once the initial analysis is complete. An investor who buys 5 to 10 quality businesses with genuine conviction and holds them for 25 to 30 years without ever selling can produce results that are competitive with or superior to the index, not because selection is easy, but because the holding period eliminates most of the costs that make short to medium-term active selection so expensive. The caveat is that this requires the psychological ability to hold through drawdowns of 40 and 50% in individual names without selling. Research on actual investor behavior suggests very few people can sustain this in practice. But the strategy is genuinely viable for those who can. Let me close with the thing the data is actually saying. This debate is not about intelligence. The retail investors who pick individual stocks are not making an uninformed choice. They are responding rationally to the financial media and content ecosystem they live inside, one that is built almost entirely on the premise that research and selection produce superior results, because that premise generates more content, more engagement, and more advertising revenue than the alternative. The alternative is 93% of professional stock pickers with full-time resources underperform the index over 20 years. The top 4% of companies create all the market's wealth and cannot be identified in advance. The 3 compounding costs of active individual stock selection: tax drag, behavioral drag, and the opportunity cost of research time silently widen the gap between the active portfolio and the index over every decade they run simultaneously. And an index fund captures all the winners automatically, before anyone knows which companies those will be. That is what the data says. Not loudly, not dramatically, just clearly, consistently, across 25 years of SPIVA scorecards and multiple academic databases and the documented behavior of millions of individual investors. The practical answer for most people is straightforward. Index funds for the core. Tax-advantaged accounts for any individual stock exposure. A defined, limited sleeve size, and the intellectual honesty to recognize that stock picking is an engaging activity that most people enjoy, and that enjoyment is a legitimate reason to do a small amount of it, while the index is the machine that actually builds the wealth. Your one action from this video: open your investment accounts and calculate what percentage of your total invested assets is currently in individual stocks outside a tax-advantaged account. That number tells you your actual exposure to the 3 cost mechanisms we covered. If it is above 20 or 25% of your taxable account, that is the conversation worth having with yourself this week. Drop a comment below. Are you currently indexed, actively picking stocks, or somewhere in between? I want to know where this community actually is on this question. Subscribe for a new personal finance video every week. See you in the next one.